Hi and welcome everyone. In our today's video, we're gonna talk quickly about IAS 36 impairment. And I would like to bring to your attention that there will be the list of the videos, and there will be the set of classes about the revision of different IAS and IFRS standards, considering the very limited time remaining till our ACCA exam. So let's start. As the name suggests, impairment is the condition when the carrying amount NBV of the assets or the CGUs are below the recoverable amount. So how the process starts? Actually, the entities are required at each financial year end to identify whether there are triggers. I'm not saying about the impairment analysis. I'm talking about the triggers. Whether there are triggers, regardless of whether they are internal or external, if there are triggers that the recoverable amount of the assets or the CGUs is below the carrying amount of the asset, then the entity or the management is required to calculate the recoverable amount. And while talking about the recoverable amount, we look at the highest of value in use, the discounted future cash flows, or fair value less cost to sell. If you remember, we also have the identification of the fair value, and we use that amount to assess whether we should carry the asset under the MBV or the fair value. But that condition relates to IFRS 5, if you remember. Considering that for non-current assets set for sale, the primary benefit will come from the sale of the asset, we are looking at the fair value of those assets, fair value less cost to sell of those assets, not at value in use. Because if we are expecting that the value in use will provide more benefit from those assets, then those will not have been regarded as IFRS 5. So let's return to our IAS 36 impairment. So as we stated, the process starts with the triggers. Then, if the triggers exist, the management calculates the recoverable amount and then makes the recognition of an impairment or its reversal. So there can be the situation when the impairment exists, and this will result in expense, which will decrease the MBV to the carrying amount, or we will recognize the income, reversal of the impairment. So how this expense and income differs from depreciation and revaluation. First of all, depreciation is a systematic, continuous decrease based on the economic benefit we are getting from those assets, and they are, on a continuous basis. And from income perspective, the increase in the MBV of the asset is also seen for the revaluation model, but the revaluation model is the choice. So entity can select based on the accounting policy whether it will carry its non-current assets under the cost model or revaluation model. So it's a choice. But when it comes to impairment, it's a must. And the entity is required to correctly apply the IFRS standards. And it has no way to waive this requirement. And if the impairment is not correctly reflected on the face of the financial statement, then our financial statement figures will not provide true and fair view, so the information will not be useful for the primary users of our financial statements. What can we say further? We can talk about the CGUs. Those are the smallest identifiable group of assets which generate the revenue, cash flow, independently. So for example, let's give an example. If we are acquiring a brand, it's less likely that we will benefit from that brand, because the brand will incorporate its economic benefit to our whole manufacturing plant, to our whole goods and services we are, how to say, producing or emitting to our customers. So in that case, brand is not separate how to say, cash generating unit. In that case, it either will be included within the CGU, or if we are not able to attach any of the items into appropriate CGUs, then we will treat them as the corporate assets, and based on the carrying amount of the CGUs, we will how to say, allocate the value of those corporate assets to the appropriate CGUs. Let's finally talk about the reversal of the impairment. The reversal of the impairment for cost model is restricted to the amount had there been no impairment. So if we had in prior year the impairment and the current year we don't have the impairment, we need to how to say, reverse that impairment figure. We should calculate what would have been the carrying amount of the asset had there been no impairment. Okay, but for the revaluation model, as we have no, how to say, limit, no ceiling for the value of the asset, we will decrease the reversal of the impairment charge by the excess depreciation. If you remember from your F3 financial accounting paper, it will be decreased by the excess depreciation from retained earnings to the equity. Finally, allocation of the impairment. Allocation of impairment firstly goes to obvious impairment, then it goes to goodwill, and then we will allocate that on a pro rata basis. Hope this video helped you. As I said, this is not comprehensive or the broad information. This is not about the broad information about this IFRS standards, just a quick revision before you are entering the exam. So hope you will find it useful, and we will have further videos in this regards for different IAS and IFRS standards. So please subscribe, hit the like button, and share with your friends. Bye, and I'll see you soon.